G'day Investorholics and friends, welcome to the ETF Spotlight Review. Today we will be doing our overview on IOZ, which is the iShares Core S&P ASX 200 ETF. This is a continuation on from our, our little series on the ASX 200 index funds. Hang around, hopefully add some value and it's worthwhile, and get you kicking off on doing some of your own research and investing. Well, hello there, Investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances. Expand your investment horizons and crack your financial sky. Okay, let's dive on into this one now. So our investment objective, the fund aims to provide investors with the performance of the S&P ASX 200 Accumulation Index before fees and expenses. The index is designed to measure the performance of the 200 largest Australian securities listed on the ASX. Quick little overview, it provides exposure to the top 200 companies listed on the ASX by their market capitalization, low cost access to the 200 largest companies on the ASX in a single trade, exposure to the leading index of broad Australian equities. This one can be used as the core of your portfolio for your essential domestic allocation. So iShares, which is owned by BlackRock, is your largest ETF manager in the world, and has very large passive funds business in Australia, underpinning its local scale and commitment, I suppose you could say. S&P ASX 200 Accumulation Index is a free float adjusted market cap weighted index. If that makes any sense here. It's Australia's best known stock market benchmark and covers about 80% of Australian equity market cap, so covers 80% of the market by value. Okay, so looking at net asset value of $22.75, trading just below that at $22.74, market cap of $1.985 billion, if I can get that out. Management cost of 0.09%. Distribution frequency is quarterly, January, April, July, October. We have a dividend yield of 5% or thereabouts. So Australian companies typically have a high dividend yield, and this is reflected in the dividend of IOZ. So it's always a good thing to have an additional income stream, especially every quarter. It definitely feels good in your wallet. So IOZ could be appropriate for the smart or lazy investors that can't decide where to invest. So you just buy the top 200 companies in Australia all at once in one trade. So buying the index and just reinvesting the dividends would allow you to pretty much set and forget for years, So Peter Lynch always says that the best investors are people who have forgotten about their investment or are dead, because people tend to want to try to chase the best performance at any particular time, and that actually affects your actual investment performance over time, because you're trading in and out of different products or different shares or whatever, so that actually hurts you over time. So he's always said that the best investors are actually those who just forget about their investment, just keep reinvesting your dividends or topping it up every now and again, but just don't do anything to it. Just let the market do all the hard work, the hard lifting for you. So for investors seeking low cost replication of the diversified Australian equities benchmark, iShares S&P ASX 200 ETF is a good option. So IOZ is a cheap, efficient and effective way to get diversified Australian equities exposure in a nutshell. So as we can see from the list of the top 10 here, it's top heavy with the big four banks, BHP and CSL, and they account for sort of about 35% range. So about half of the portfolio is giant caps, with most of the remainder being large or mid cap size companies. So earnings among the largest Australian companies are, typically home biased, with the big banks, supermarkets and telecommunications providers largely generating their earnings domestically. So, we can kind of see that we've had a decent return since inception here, plus 70%. I mean, that's after the big COVID crash. So, if before the COVID crash you're up a fair way, so the index is actually tracking pretty well. But even having said that, you're still up 70% even after the crash. So definitely nothing to sniff at unless you've actually bought at the top before the market sort of got a bit jittery and dropped off that cliff there. So I think definitely worth having a look at. So it's an ETF that could sort of create a core to your Australian equities allocation. Low cost, low turnover, pretty well tax effective, and it mimics the index quite closely, so you kind of know what you're going to get. So as I sort of mentioned before, it's definitely a possibility for a set and forget. One to actually have a bit further of a deeper dive into and see if it might suit your particular circumstances, but definitely one to have a bit of a closer look at. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's KrackTheSky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.